The Criminal Code of Canada says that it is a criminal offense to charge an interest rate of more than 60%. The federal government is considering lowering that rate. Sounds like a good idea, right? What could possibly go wrong? Ted and I discuss it starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
As I said back on episode number 418 of Debt Free in 30, many of our shows this season will discuss what's happening in the world and how it impacts you. So today we have a story for you that I have not seen reported in the media, but could have a significant impact on Canadians. On August 9th, 2022, in the middle of the summer holiday season, when no one's around, the Department of Finance published a consultation paper to get feedback from you and me and Ted, obviously, about the maximum interest rate in the criminal code and how it relates to high-cost installment loans in Canada. The government will be accepting your comments until October 7th, 2022. You can send them an email with your thoughts. So time is ticking, so let's discuss it now. So Ted Michaelis is here, eager to make his first appearance on season number 9. So Ted, let's start with some history. And just so we're clear on all this, we are not going to be talking about your favorite topic, which is payday loans.
Right. No payday loan content today. Even though those are really high interest loans. I mean, they put these other interest rates to shame.
And that kind of begs the question, right? So we've got the criminal code that says you can't charge more than 60%, but payday loans are excluded. Way more than 60%.
That's right.
They are excluded. And they're excluded because they are provincially regulated. Does that make sense?
I don't know.
But that's the way it is. So we won't be having that discussion today. So today we are going to start by talking about Section 347 of the Criminal Code of Canada. What does Section 347 say?
Well, as everyone knows, I'm sure, it's a criminal offense to charge more than 60% interest on a loan.
Yeah, and I will put a link to the criminal code so you can read it yourself. It's not a very long section. It's actually pretty short.
Right.
And there's actually two parts to it. It says that you can't charge that rate, and you can't also request someone to pay that rate. Okay, well, that seems like kind of the same thing, but, back and forth.
It must mean something different under the law.
Well, and there's obviously all sorts of case law on it, but for the purposes of our discussion, it's 60%. And that section of the criminal code was introduced when?
1980.
We're going to talk about
our lifetime.
Yes, exactly. We're going to talk about the significance of that. It was introduced, Bill C-44, as of course I'm sure everyone knows, which repealed the Small Loans Act, which was passed in 1936, which I believe was pretty much the height of the Depression, wasn't it?
Yeah, certainly the peak years.
And it was designed, the Small Loans Act was designed to protect consumers from high interest rates and costs on personal loans below $1,500.
Now, we probably should have adjusted that $1,500 for inflation, right?
Yeah, and so it would have been certainly a bigger number than that. I don't know, maybe it's 10 grand, maybe it's 20 grand, but we had periods of inflation and deflation back there as well.
Right.
But the ceiling was relative,
but in 36 you could buy a house for $1,500.
Well, there you go. So maybe it was a much bigger amount
anyway,
than we're
doesn't
giving
matter.
Credit for.
I digress.
So that was there, and of course, by the time we got into the 70s and 80s, well, okay, $1,500 was not really a big number at all,
right?
And so the banks got bigger. There were more people giving loans, and so, but before 1980, we kind of got to the point where let's just let the market decide.
Right.
Who cares about regulation? We don't really care.
Yeah.
So if the borrower thought the interest rate was too high, I don't get the loan. Pretty simple. So why did the government decide it was necessary to have a law capping the maximum interest rate?
Well, so they capped the interest rate so you didn't get your kneecaps.
So you wouldn't get your kneecaps. Okay, so give us a little bit of anecdotal history that you can just make up about, was that a thing? Was that a problem? How were people borrowing money when they couldn't go to payday loan places back then?
Yeah, well, so think back to the early 80s. I mean, interest rates were ridiculously high. I remember my first car loan was at 22%.
And what year was that?
That was 1981.
Jeez.
So, I guess the law was already in place at that point.
There you go.
But the risk was that they're afraid of, I guess they call it predatory lending. So I'm going to, fall back on my heritage here.
One day, and that day may never come, Doug, you will ask me for a loan.
I thought you were Greek, not Italian.
I'm a quarter Sicilian.
Oh, a quarter Sicilian. Well, there we go. There we go. So, yeah, the big worry was that this was all kind of off the books.
Well, and let's go back in time. Credit cards actually weren't a thing until early 70s. Before that, you had Diners Club, which was a charge card, and American Express, and that evolved into credit cards. So before you had credit cards as a common thing, you had lots of, they used to call them savings and loans, right? So you would put your money in an account as a savings branch, and they would lend it out, and the interest rates could be whatever they want. I mean, in those days, if they were giving you 3% on your savings, they were probably charging 15% on their loans. And that was a common thing, well, throughout North America. There were companies like Household Finance, which most of our listeners probably won't remember ever hearing of, Superior Credit. A recent one in Canada was TransCanada Credit. You guys, everybody's probably heard of Wells Fargo. All of these guys used to be in the business of giving out loans at 15 to 20%. And then credit cards came along, and the banks realized, well, hey, we can just give you this revolving line of credit and a little plastic card and charge you, 10, 12, 15, 29% interest. Well, so that pushed the lenders then to the next tier up from the 20% to the 30s to the 40s. And so the concern was that the market was allowing all sorts of these tools where you could borrow as much money as you wanted if you were willing to pay the interest rate. And if you couldn't pay, well, there were repercussions to you physically as opposed to fiscally.
Ooh, physically versus fiscally, which is why they brought in this law in 1980.
Right.
So that kind of makes sense, but it's easy to see a way around it. So if the interest rate is capped at this, okay, fine, I'll charge you an interest rate lower than that, but I'll add in fees and expenses and a monthly fee and a charge and whatnot.
Well, and amazingly, they actually foresaw that. And so the interest rate is basically whatever fees you're being charged to borrow that money. A couple of the high interest lenders used to do, so they'd give you the loan at 17%, but then they would charge you some sort of insurance clause that doubled that to 34%. So the advertised rate was 17, but the real rate was 34. All of that was designed to keep them within the usury laws under 60%, but to confuse the consumer.
Yeah, and this eventually got to the Supreme Court because the gas company, Consumers Gas, as it was called then, now it's called Enbridge, had a rule that, okay, if you don't pay your bill on within the X number of days allotted, then there's a $5 fee added to that.
Right.
And $5 back then was significant. And if your monthly bill was only $20 or $50 or $30 or whatever, an extra $5 was a huge number when you looked at it in terms of interest.
25% for 1 month. So over the course of a year, that's 300%.
And the Supreme Court said, yeah, no, you can't do that. And so there was a class action case. It was called the Garland case. Joseph Garland, who was a customer of Consumers Gas, between 1983 and 1995, he and his wife paid approximately $75 in late payment charges. Doesn't sound like a big enough number to get to the Supreme Court, but of course this affected every consumer. So they started a class action lawsuit. And they said, hey, you can't charge me you can charge me interest, but you can't add more charges. And the Supreme Court agreed.
Right.
So they made their initial ruling in 1998. And then again, the Supreme Court again in 2004. Well, now it's 2022. So why is it that the government is looking at this issue of criminally high interest rates now, 18 years later after the Supreme Court last ruled on this?
Well, we've been experiencing something interesting the last few years. The prime rate, so the Bank of Canada rate, has been ridiculously low. And yet there's been a huge increase in high interest lenders. Let's call them installment loans or, I don't want to talk about payday loans, but they all seem to be provided by people that provide payday loans as the basis of their business. They're available through the internet, and the interest rates are usually somewhere 29 to 39%. And that's the advertised rate. So when you start adding in fees and the like, you know that they're bumping up against that usury limit of 60.
Yeah, and I guess that's why they're looking at it now. So, and we want to be very clear here in our terms. So the prime rate, also known as the prime lending rate, is the interest rate a financial institution uses as their base to determine interest rates for their products. So you might have a line of credit at prime or prime plus 1 or prime plus 2 or whatever. And of course, mortgages and everything kind of flows from that as well.
Well, and what's the Bank of Canada rate?
That's called the overnight rate, the Bank of Canada rate, which is a different thing. Now, of course, both of them are very low right now, but what we are talking about here is the prime rate, and which is, of course, something that comes from the banks.
And so interestingly, the overnight rate is usually in the media. You can pick it up pretty easily, but the prime rates, you got to dig around to find them.
Yeah, and every bank, of course, can set whatever prime rate they want. They all tend to be pretty much the same. And obviously, they are based on the Bank of Canada overnight rate, because that's what kind of drives it, more at the short end than the long end. But we're not going to talk about inverted yield curves today. So, okay, we already said that Section 347 of the Criminal Code was changed in 1980. Why was it 1980 and not 1970 or 1990? What was the big thing?
Again, from my anecdote earlier, in 1980, interest rates were insane. I mean, that car loan was at 21 or 22% interest.
And I'll put a chart up on the screen for those of you who are watching on YouTube. And if you are watching on YouTube, hit all those buttons, likes and subscribes and whatever they are. In April 1980, the chartered bank's prime lending rate, which is what we just talked about, hit 17.5% in April. Then it eased off a bit. And then in August and September of 1981, because Ted was getting a car loan, it hit 22.75%, its all-time high.
So what you're telling me is I got a great rate for the time.
You nailed it. Yeah, you nailed it perfectly.
It didn't feel like a great rate.
Wasn't perfect. 1-year mortgage rates back then were over 21%. Now, this didn't last for a huge amount of time, but as you can see on the chart, they spiked way up and then have been essentially falling ever since for the last 20, 30 years. So if the banks were charging 20%, a criminal interest rate of 60%, doesn't seem that out of whack. I mean, that's 3 times higher than what the banks are charging. So, but here we are in 2022. We started this year with the chartered bank's prime lending rate at 2.45%, so just under 2.5%, and it started going up in March, and by the end of the summer of 2022, it was 4.7%, so closing in on 5%. And again, we're talking about the bank prime lending rate, not the Bank of Canada overnight rate.
That's the rate the best customers get at the bank.
Exactly. So the Bank of Canada target overnight rate started the year at pretty much 0, 0.25%, and it got all the way up to 2.5% on July 13th, 2022. And of course, you're watching this show at some point in the future, so who knows what the interest rate is then. But the point is, back in 1980, the criminal interest rate was 3 times the prime rate. So should the cap today be something similar? Should we take the prime rate and multiply it by 3 or some other percentage point? Like this is what the government's asking. They're consulting. So I'm asking you, what do you think they should set the usury rate as?
And I suspect that they didn't use a multiplier of 3 to decide on the 60 way back when in 1980. I don't know what method they would have used, but I think it's just coincident that it was 3 times. What we've got to determine, so what's a fair interest rate for people to be paying? And unfortunately, I go back to what will the market bear?
Yeah, and ultimately, that's kind of where we're at now. Because even with very low interest rates, there's still lots of credit cards that are 19.9%.
Sure. Well, and in fact, again, some history here. Many of the old style retail stores made money off their finance divisions as opposed to selling their product because they had store cards, whether it was, Sears, which is gone, Eaton's, which is gone. All those places were charging 29% on their purchases. So it didn't matter if they didn't make the margins on the sale because you were paying them ridiculous interest on your credit card.
Yeah, it's kind of like Costco makes all their money on the membership fees, and they can sell the goods for break even, and they're still doing fine.
And Costco pays in 60 days, and you buy the stuff within 2 weeks of them receiving it. So
there's a bit of a float there as well. So yeah, okay. If the chartered bank's prime lending rate is 5%, 3 times that would be 15%. Well, there's no way they're setting the usury rate at 15% because that's less than what credit cards charge. So that doesn't make any sense. I guess the whole theory of it is that lenders are more powerful than borrowers. Banks are a lot bigger than you and me. So do you agree that the government needs to do something to protect the borrower, or do you think it is something that the market can just decide?
I mean, I think traditionally the banks have kept pushing to get higher rates and higher risk loans, pushing the folks that were in those businesses to even higher rates and higher risk loans. So if there isn't some kind of regulation, it could get interesting.
Yeah, or at some point the whole system collapses, I guess, and
Right.
there is no lending. So right now we have a fixed rate, 60%. It's been there since 1980. Would it make more sense to have a rate that is set perhaps on an annual basis? So, once a year, the government says, well, okay, interest rates have gone up, so we're raising the rate. Interest rates have gone down, we're lowering the rate. I mean, there's lots of other areas where that happens. We're in the insolvency business. There's something called surplus income, and that's a rate set by the government that changes every year.
Have you seen it go down ever?
No, it's never gone down, even in deflationary times, I guess. But the point is that would be one way to handle it. Does that make sense, or would that be so cumbersome that it's just
Well,
impossible?
it would start to get complicated too. Let's say you had an inflationary spike; things were going up. So I took out my loan when the bank rate was 5%, so 15 was our cap. Somehow the bank rate got to 12%, and so now my cap is 36. But let's say at deflationary times, and it dropped back to 5 again. Am I now everybody who got a loan at that higher rate now? Is that illusory? Or are you saying that everybody's got to have a variable rate loan no matter what they borrow anymore?
These are all very good questions.
I guess that's really the solution, right? Everything becomes variable. There are no fixed loans anymore.
Yeah, and then that makes it very dangerous to be borrowing because I don't know what I'm going to pay.
Right.
I mean, obviously it's
and it makes it dangerous to lend.
Yeah, because you don't know what you're going to get back. So obviously a lot of mortgages today are variable rate, but and would it be that here's the rate at the time you got the loan, and so that's fixed for the term of the loan? It doesn't matter what the cap is. So long as I got the loan at such and such a date when the cap was that, it doesn't really matter what happens in the future. So now let's go back to this idea of let the market decide then. So why is it that somebody would borrow at these high rates? And we, of course, do the Hoyes Michaelis Joe Debtor bankruptcy study every year. And on that study, we show that there are a significant number of people, well over a third of our clients, it's up in the 40% range of our clients who have loans from these high interest lenders.
That's right.
So why would someone take out a loan when the interest rate is 45%?
Well, for the most part, they don't think they have a choice. Or the reality is they don't have a choice. If they got to borrow, they have to borrow from somebody that's a high-risk lender, subprime, a B lender, whatever you want to call them. These are folks that specialize in giving loans to people that don't qualify for loans from the banks.
So are they charging 45% because that's what the market will bear? Or are they charging 45% because they know the cap is 60% and they have to stay under it?
I believe it's the latter, not the former.
So it's because there's a cap.
That's right.
So if there wasn't a cap, you think they would charge 70%?
Well, let's look at payday loans. The cap is significantly different. People borrow. If there was, the government lowered it from $20 to $15 for, $100 over 2 weeks.
Well, in Ontario, they can charge $15 on 100. Doesn't really matter if you're borrowing for one day or 3 weeks. It's $15 on 100.
But the industry doesn't publish this information, but I'm willing to bet when they decreased it, there wasn't an increase in borrowing. And if they increased it back to $20, it wouldn't change the rate of borrowing. Well, the people that are borrowing that money are stuck.
Right. When they decreased it, it used to be $18. I think it was as high as $20 or $21. They brought it down to 18, then 15 on 100. What those payday loan companies did was they flipped over and started doing installment loans.
Right. The installment loans are subject to the usury rules, so the 60% cap, which is where we get into these 45% people.
So if a typical payday loan is less than $1,000, and I get to charge 15 on 100, that's $150 for the 2-week loan. But if I can loan $10,000, even though maybe I can only charge 55%, I'm still making a nice bit of interest because the pot is that much bigger. So, okay, and I don't know the answer to that question. If they raise the cap, would the interest rates go up? Obviously, if they lowered the cap, interest rates would have to come down because there's no other way to do it. But does that then mean that the lenders go, you know what, the reason we're charging that high of an interest rate is because the borrower is a high-risk borrower?
Well, I mean, you and I know that traditionally the actuaries have told banks that, you know what, you want 1 out of every 100 customers not to pay. You're maximizing your profit on the other 99. But we know these high-risk lenders work on a different theory. I think they've got their default rate is up to 10%, and they still think that they're making a profit. So obviously the interest rate is designed to compensate for the fact that they're going to have a much higher default rate.
Yeah, so again, it's all hypothetical because we don't know what changes would happen if they were to change the interest rate. And I guess some people are watching this going, look, I don't care about any of this.
Right.
I'm not paying high interest rates. I've got good credit. It doesn't affect me. But what about the ripple effect?
Yep.
So if the criminal code is amended to lower the highest interest rate, so let's say they bring it from 60% to 40%, does that ripple down to the rates charged on lines of credit, credit cards, auto loans? I mean, could that impact the availability of credit for everybody?
Well, so anything that limits the amount that the highest risk lenders can earn will drive some portion of this underground. So that's a different conversation. But we already know that the banks are now lending people through credit cards and various credit tools stuff at upwards of 19 or 20%, depending on your credit worthiness. And so if the cap is moved from 60 down to 40, my guess is the banks will continue to encroach on those higher interest rates, 20, 25%. So all the guys that used to make 45, 50, 60%, they're going to be driven into a different type of market.
Well, so you raise a very interesting point, and that's driving things underground.
Right.
So that is probably the main counter argument to whatever it is the government does.
It's everybody's fear.
Right. So, I mean, prior to the pandemic, marijuana was illegal. Mm-hmm. And if you were caught with it, then you potentially could go to jail. And then they made it legal, and then it became an essential service. So 3 years later, it was an essential service.
They're everywhere.
It's everywhere. And so there is less incentive now to drive something like that underground.
Right. Because
if I happen to be growing the plant at my house, well, nobody cares because it's legal. So perhaps we have reduced the criminal element to that. If the interest rate that they can charge is 60%, I don't have to go underground.
Right.
That's legalized loan charging, right?
Right.
So, but if you make it 40% or 20% and the lender decides, well, that's just not a good risk, I'm not going to do it, then do we go back to the way it was where your Sicilian relatives are breaking kneecaps?
I mean, all of that started in the workplace, right? It's called a payday loan because you ran out of money and you needed something to get you to the next payday. Well, Luigi did that by saying, okay, here's $100, so you're going to be back 150.
And the word underground has a current context to it.
Right.
Because you and I got a message from one of our trustees last week, whose name shall remain nameless, but it's Maureen Parent. She'll be on the show in the next few weeks. And she had a client.
Yep.
Who, well, do you remember the story about what specifically happened? So
this person took out a loan on the internet. So ostensibly it's a payday loan because it was under $2,000. I mean, the payday limit is $1,500, but regardless, they borrowed from this company on the internet. Now, unfortunately, the client, because of their other debts as well as this one, decided that they needed to file a consumer proposal to get relief. Their situation wasn't tenable anymore. Well, the company that lent the money to the client sold the loan to a company that is representing themselves as being offshore, which means they're not based somewhere in North America. The actual loan company was based somewhere in the U.S. The collector, or the people who now bought the loan, say they're based out of Mexico. And they don't give a damn about Canadian law. They don't give a damn about what kind of a consumer proposal is or to do that. If the guy doesn't pay them, they're going to make their lives miserable. And what they were doing was they were calling his employer every 4 minutes. And whenever somebody answered, they just canceled the call. And they were doing that throughout the course of the day. Then they sent through a text and an email that basically said, I don't care what you've done in Canada. Pay me or I'm going to keep doing this.
Yeah. So that is your classic intimidation.
Right.
It's new school intimidation as opposed to old school. They're not breaking your kneecaps. But can you imagine you're at work and the phone at reception is ringing every 4 minutes?
Well, and this guy is fairly senior in the company. And so he doesn't own the company, doesn't run the company, but he's in the top tier. And so just the embarrassment of the whole thing.
Yeah. And so it's like, we don't care what the laws are. We know you're going to be able to come up with the $1,000 or whatever the amount was and pay us off. And that's that. So that's an example, I guess, of a situation where it doesn't matter what the interest rate is. It doesn't matter what the laws are.
Right.
If they can't be enforced, then what are you going to do? So I think underground, the common word for that today is I got a loan over the internet.
Right.
And if the lender happens to be in Mexico or in Europe or somewhere else, what are you going to do? You make a complaint to the government? Like the laws just don't apply. So one of my objections to whatever laws the government brings in is that are they even enforceable? Right. Because if they aren't enforceable, then it's not really much of a law. So okay, to close the show then, Ted, you get to give whatever your recommendations are to the federal government. They've asked, and I think they asked you specifically. That's what I got out of the consultation document. And again, I'll put a link to it in the show notes. So if anybody else wants to send an email or a submission to the federal government, they can do so. Do you think they should make changes to the criminal code and the 60% usury rate that is in place now?
So I believe there's value in reviewing how the original decision was made. My guess is that we got some pretty smart actuarial people out there that can tell us if the maximum rate remains at 60%, this will be the impact. If it's dropped to 50, it's increased to 75. We can then make an informed decision of, okay, how low can we go before we start driving a significant portion underground? How high do we go to the point where it's just people are suffering? And do we just need to change the regulatory framework so that maybe it's a tiered system? So this type of loan, the cap is here, this type is here. I mean, a single cap for everything, maybe that doesn't make sense anymore.
So you would favor a somewhat more data-based approach. Let's actually do some research.
Right.
So rather than having a questionnaire go out to people like you and me who just give our opinions, well, I think this is what it should be.
I can give you anecdotal evidence, but I'm sure that there's somebody out there that can do the math.
Yeah, and I guess it's a cause and effect thing. So we don't know for sure what the effect would be until we actually did it. But there must be other jurisdictions they can look to. And should they be bringing in payday loans into the whole discussion then?
Right. And I don't see how they can leave payday loans out of this. I mean, I understand it is provincial legislation and they're each setting their own rate. But the rates that those folks charge are just so onerous. I mean, it drives me crazy.
Yeah. Well, and there is no obviously simple answer. I mean, it's true that interest rates are a lot lower now than they were in 1980, and they go up and down. So instead of having a fixed cap, it's not unreasonable to have some kind of cap that goes up and down with prevailing rates.
Right.
But that becomes a bit of an administrative nightmare. It could be a multiple of the Bank of Canada overnight lending rate or the Chartered Bank's prime rate or whatever. But if the cap was 10 times and the Chartered Bank prime lending rate is 5%, well, that would be a 50% limit.
Right.
Is there a big difference between 50% and 60%? I don't know.
But if the rate is 10%, they're talking about 100% limit.
Right. So then that would actually increase the limit to where it is now. So you can't really do it as a fixed multiple because then you might get the absolute opposite result. So, and you're right. If we go back to 1981 when the bank's rate was over 20%, so what, we're going to set it at 200%? I mean, that just gets crazy. So the other problem is that these laws are generally only activated by consumers.
Right.
So unlike a fine or a penalty that's imposed by the government, it's the consumer who must make a complaint to say, hey, wait a minute, this is over the limit.
Right.
And that can only happen if a consumer understands their rights, and they have to be able to understand and identify the crime. Well, that's pretty difficult.
Right.
And
in fact,
fact,
most consumers can't tell what interest rate they're paying. So how the hell are they going to know if their law's been broken?
And in fact, the criminal code, section 347, actually says if you want to object to this, you have to get an actuary to do the math because it is difficult. So if you've got a loan that you're paying this much every 2 weeks, can you figure out the annual rate? I mean, it's not as simple as there's one payment a year when it's pretty simple to do the math.
Well, and as a perfect example, most of the high interest installment loans on the internet are something like 39.99% interest, but the actual imputed rate is somewhere in the neighborhood of 52%. And so that extra 13% is coming from somewhere, and the average person can't figure it out.
Yeah, if you're making payments at a different schedule than monthly if you didn't make the payment within 30 days away. I mean, there's all sorts of different
and don't
things
forget, we're adding in all the admin fees and the insurance costs
Right.
and whatever else they can hit you for.
So it's not a simple calculation. So, okay, so I've got 4 recommendations then. Government, if you're listening to this, is the mic on? Yes, here we go. So here you go, federal government. Number 1, disclosure. I think you hit the nail on the head.
Right.
Consumers have to understand exactly what they are paying and what the annual interest rate is.
And we've emphasized that every time anybody asks us about interest rates or what you're being charged for something, always make sure you understand the cost of borrowing.
And I will admit that the government has improved on that. When you get your credit card statement, it says if you only make the minimum payment, it's going to take you 122 years.
It's on you to read the damn thing.
And understand it, right. And same with a payday loan. There is a disclosure form,
right?
But the disclosure form says you're paying $15 on 100. Do you fully understand the implications of that?
Okay.
I think secondly, because this is a consumer-driven thing, there should be some kind of complaint mechanism for consumers. So again, it's difficult to calculate it. And if only an actuary can calculate it, and you can look at section 347 sub 4 where it says that, then how is a consumer supposed to figure it out? So maybe what we need is a website where I can take my loan document and upload it and say, hey, government, tell me what the interest rate really is.
If you were going to do that, wouldn't it be easier to require all lending institutions to pre-submit their calculations? And so that, okay, it's got this is government verification number, XY.
I like that. I mean, every mortgage broker has a license number.
Right.
So maybe that's exactly the way it has to work, that it gets punched into the government's computer and boom, here it is.
In this age of computers, it's got to be easy to do.
There you go. I like that.
You're filling out the application. It sends. It goes to the government, verifies, yes, fine. And then the government asks you a question. Do you understand you're being charged $2 million percentage?
And so every loan would have a government ID number on it.
Yep.
And you as the consumer could then go to the computer, type in your ID number, and make sure that the thing was pre-submitted.
You know my feelings about big government.
I know. So now the government knows everything. And this is the point. There's some good and some bad.
Right. There's a trade-off.
So I kind of like the idea that the government is checking, but do you want to punch in every loan? So now the government knows every single loan that Ted Michaelis has.
Right.
Especially the 21% loan to
What's
buy
your
a
third
car.
point?
Number 3, maybe we should make the loan agreement standardized and simplified so we could actually understand it.
Yeah, that would work too.
So if I was regulating all the stockbrokers and investment people, I would have a know your client form that says you could lose all your money. And that'd be it. That'd be the whole form.
Right.
Instead of the 47 pages of disclosure. So maybe even though there are some standardizations, we could make that even more standardized, simple, and so on. And then finally, I think the key point to all of this is education, which is, of course, exactly why we do this show.
Right.
So that we can explain what these issues are so that perhaps someone is watching us today and goes, hey, maybe I will pull out that loan document and actually try to figure out the number or look at it. If you understand what's going on, then I think you got a little bit better of a chance.
That's right. All we really want you to do, folks, is to be able to look at and go, I am knowingly signing this agreement to pay 45% interest. If you do it and you know you're doing it, I'm less of concerned than the fellow who just signs it because I got to have money to pay the rent tomorrow and I don't give it to him.
Right. And I totally get that. I get paid on the 5th of the month, but my rent is due on the 1st of the month. What am I supposed to do?
Right.
And maybe the answer is, well, you got to talk to your landlord and say rent's going to be 5 days late. Maybe there is nothing you can do, but I agree. If you at least know what you're getting yourself into, you got a fighting chance. So that would be my final recommendation. So there you go. Big government is coming as recommended by Ted. We're going to have this big computer and we're all going to have to punch in every loan. So
I'm not going to be able to go home.
Leave a comment. Exactly. Leave a comment on YouTube as to what we really should have thought about because we perhaps have missed the point. But again, the government is looking at this. I don't know what they're going to do. Probably nothing. It's been since 1980. I don't know what changes are going to be made. But
when's the next election?
Well, not this year. So I don't think this is an election-driven thing because I don't think anybody's thinking about it. But if interest rates go up or down or whatever, then maybe it becomes more of an issue. Right. So there you go. The criminal code. You all know what it says. Read it, respond, and come up with your own answers. That is our show for today. Again, if you're watching on YouTube, hit all those buttons and, by all means, leave a comment. Tell us what you think should be the answer to this. I'm actually quite interested in what other ideas people come up with. And this show, the audio version, is also available on all the major podcasting apps, Apple Podcasts, Google, Spotify. You're a big Spotify guy, are you?
Sure. What is that?
He doesn't know what Spotify is.
I don't know what Instagram is.
There you go. And nor should you. So Just type in Debt Free in 30, subscribe. You get the new episode every Saturday morning. And so, thanks for listening. Until next week, for Ted Michaelis, I'm Doug Hoyes. That was Debt Free in 30.